G'day folks, welcome back to another update for natural gas. Now the prices have retraced somewhat since our last update, but overall the trend still remains bullish. And plus starting from today, I'm going to include back testing in terms of how to trade using stop losses, but also averaging down approach. In terms of the outlook, as of today, March 9, production growth, the Permian Basin is projected to significantly boost US oil and gas production in 2025, with oil output expected to rise from 13.14 million barrels per day in 2024 to 13.64 million barrels per day in 2025. Dry gas production is also anticipated to increase from 102.9 BCF per day in 2024 to 106.8 BCF per day in 2025. The price forecast, the Henry Hub price is forecasted to increase 342, driven by domestic demand from new data center projects and international demand from LNG projects. For bearish indicators, despite production growth, some analysts note that bearish fundamentals are beginning to reassert influence over natural gas markets. For the natural gas demand for AI data processing, increasing energy consumption, the rapid growth of artificial intelligence is expected to drive a substantial increase in data center power consumption, estimated to rise by approximately 200 terawatts per hour or per year. And the role of natural gas is anticipated to play a crucial role in meeting this escalating energy demand, providing a reliable and efficient power source for data centers supporting AI technologies. So looking at the natural gas price first, we'll look at the long-term trends. We've got the monthly, the weekly, and the daily. So on the monthly, you can see there we're still bullish on our CCI 150, well above the moving averages. Likewise, the price has been bullish now for a number of months. On the weekly, also bullish movement above the moving averages. Had a bit of a dip there, but still bullish, very bullish on the weekly price chart. And on the daily, if I zoom into this one, you can see there we've actually hit this resistance and it's actually pulling back towards this diagonal ascending trend line. So we'll see how far that goes. That's in alignment with this pullback on the CCI as well, coming back towards those moving averages. Now, if we go to the intraday chart, we always look at the micro levels as well, even if you're trading on the daily. So at the moment, you can see that since our last update, it's actually pulled back and retraced further. And we've got this bearish momentum down here. It's bounced, and at the moment, bullish movement on the CCI and also the price. And that is alignment with this, the CCI breaking above the moving average band at that point there on the daily. So only trade with the direction of the higher time frame. So if you're trading on the 1 hour, the 2 hour, etc., this is the 1 hour chart here, go in the direction of the daily. You avoid taking short trades so long as that's bullish there. So the trading strategy is going to use the CCI 150 and the moving averages on the charts as I've always been demonstrating. But in terms of what instruments you're trading and what time frame, if you're trading shares, we trade on the daily time frame and you invest $1,000 per trade. And when you average down, you reach a max of $10,000. So in other words, you don't want to put your whole bank account into it, and take profit of 3%. And whenever it averages down by 5% or more, that's when you average down and add more to the contracts, assuming the CCI moving averages are broken to the upside if you're trading long, and likewise the moving averages on the daily on the price chart as well are broken to the upside. The same logic applies on the CFD contract. So if you're trading, for example, on the 1 hour, you trade one contract per trade with a maximum of 15 contracts to be opened. You don't take any more because you don't want to risk your full bank account. And take profit is 0.003%. To take profits, and average down of whenever the price breaks lower than 0.005% on the 1 hour time frame, you average down assuming all the entry parameters are met as per normal. So what I've got here, this is the daily chart. Remember, we always trade in the direction of the daily. So you would have gone long during this period. You would have avoided going short during this period because the price is still above the moving averages, and you would have started going long again here. And what I've got here on the right, this bottom chart or bottom graph is a product profitability for the averaging down. You can see there's contracts being added. You start off with one contract there. There were 3 contracts there, 7, and then ended up with 15 contracts, and then it closed out. This one up here is the stop loss strategy. So whenever you open a contract and you close it out with a stop loss when it reaches a 3% or a stop loss, you can see there with that stop loss there when the price fell, it got stopped and the profitability fell. This one opened there, it gained a bit there, then the next entry lost a bit, and this one lost, it broke even, down to the baseline is 100,000 for both the profitabilities. And more recently, you've opened a contract there, that's still open, and this one on the stop loss one, that's also still open. But you'll notice in this little period on the daily for the 1 hour trading, since that point there when it's opened here at the around the 4th of March, the average down approach has generated 3,975 so far, and the stop loss strategy has generated 1,405. So again, we only go in the direction of the daily. Now, again, as I said, you don't take this trade, you don't go short in that period because the price is still above the moving averages. You want to see the price break like it did back here, and I'll demonstrate how that would have looked had you gone short during this period. Alternatively, you would have taken so let me just mark these. You would have taken a long entry there, a long entry there, a short entry there, and these ones would have been long entries as well. But let me demonstrate very quickly this long entry as well. Okay, so what I've got here, I've got the back testing going back to the 6th of February, which coincides with this point here when the CCI broke above the moving averages and the price at that point. So you would have taken long entries from that point on, at that point. And you can see there, and you would have closed out the position when the price broke, when that CCI broke into that moving average range on the 24th of February. So around this point here. So you would have closed it out. Let me just mark that. Let me just, at that point there, you would have closed it out, which would have been around that point there. And that happened to be, and also at this point on the stop loss strategy. So you would have stopped long trades at that point. Now this program just continues running, but I'm just demonstrating what you should have done. So at that point on the stop loss program, it generated up here. It's a bit hard to read that. Let me just. You would have generated $4,000 if you're trading one contract. You can see there one contract was entered across each of those. On this one, with the average, you had a few average downs there. That would have generated $10,060. So $6,000 more in that period when you're going long during that period. So what I've got here now is the short program. So had you started it back here when the price broke below the moving average, and so did the CCI, you would have gone taking a short entry, and that's indicated by this starting point here. Now you'll notice that what I've got it marked there, you would have stopped that program when that CCI broke into that moving average range, and that would have been at that cross there, and that would have generated, depends, let me just get it right, would have generated, according to that, about 8,350. So you would have avoided taking going short, obviously, during this period when the price started rising. So again, this program is just showing you the full result. So you can see there, had you let it go, it would have used up all your capital. So you've got to make sure you're pretty tight with the stop losses. The other thing to notice as well is, let me just zoom into this period here. You'll notice here, when it started rising, you'll notice what we've got here. We've got a bullish divergence. So always pay attention to these divergences. So if you're trading this on the hourly in this example, you're seeing lower lows on the price but higher lows on the CCI. So had you been tracking that and you started, and this still would have been going short, but theoretically, you would have avoided taking, and that would have been your first point there, that would have been your first at that trough there on the CCI, but also the price. The price was declining at that point, and the CCI was rising to that point. That would have been your first indication. You might have entered into the trade, but you would have noticed that was a bullish divergence, which means you would have the short program should have been stopped. So had you stopped it at that point there, you would have closed it out with $8,990 profitability and let it go. Now in this case, that continued to close out with a bit more, but don't take your chances, because you would have added more contracts. Yes, it did close out, but you want to follow the rules strictly and get out before that bites you in the butt. Next, we look at BOIL. So on the monthly, we've got a bearish trend. It's below its moving averages. There's no CCI on the monthly. On the weekly, we did have this bullish divergence versus lower lows on the price, and that actually broke up through the moving average band. So you would have started going long on the daily if you're trading the daily. And on the daily, it did hit this resistance up here at 107.11, and it's starting to pull back the last couple of days. And that's a result of this bearish divergence we drawn on our last video. So it's starting to come back. And if I was to draw a target area for that on the daily, draw a Fibonacci back to there, you can see there it's already hit the minimum level with that the wick on that candle. So if I pull that back to there, that's the 23-38% range of a target, and it's already hit that with that wick, and the chances are it's going to fall further. You can see there the CCI is declining on the daily. It's currently in that moving average range. Very likely it's going to drop further in the coming hours or days. Now if we go to the intraday chart, what we've got here is I've got the 1 hour chart. Let me go back to the daily for a moment. So that, again, we don't go long or short on the hourly or the intraday because the CCI is in that moving average range. And you wouldn't have gone short during this period because why? Because the price is above the moving average band. You want to see the price and the CCI above the moving average band like it was back here to go long. Now at the moment, as I said, the hourly is showing a bearish divergence as well, which happens to coincide with the daily bearish divergence. They don't always do that. And at the moment, it's actually broken above the moving average band on the 1 hour chart, and so is the price. So it's actually bounced off this diagonal trend line, and we possibly may see further upside here. If it breaks through this resistance, we might see further upside, which may then invalidate also the daily. But again, I'd like to see it break above this moving resistance. So what I've got here for BOIL is the back test using the average down approach, the blue chart, and the brown is the stop loss approach. And I've got here, this is on the daily. You can apply this to any time frame on 1 hour. If you're applying to the 1 hour, again, refer it to the daily, but what I've got here is the weekly trend. So following the weekly trend, and we've got the daily trade here. So again, that would have started back there. If we zoom in to the weekly, you would have taken your first long trade back there when the price broke above the moving average band, and the CCI is already bullish. So around this area, you would have taken your first long trades there. Now, up until from that point, you'd still be in the trade with entries and exits based on the daily trade. And at the moment, so far, the average down approach has generated $1,081, and the stop loss approach has generated $555. Now you'll notice there with the average down approach, we average down once, and again we're using investing. Remember the trading parameters for the contracts on the natural gas price. We're using contracts, 1 contract per entry, and you average down every 0.005%. This is shares. So if you're trading on shares, we buy $1,000 worth. And you can see here, if we bought $1,000 worth here, they were each of these bars represented $1,000 in the trade. And when we entered more here, we just added another $2,000 on top of that. So that was now $3,000 invested. For the stop loss approach, you never average down, you always stop out. That's why it's a bit more profitable when you get the average down approach. So for KOLD on the monthly, we're still bearish, well below its moving averages. There's no CCI for it on the monthly. On the weekly, it's been bearish now for a number of weeks, since around end of 2024, on both the price and the CCI moving averages. But notice on the daily, we've got this bullish divergence, higher lows on the CCI versus lower lows on the price. That actually hasn't broken above the moving averages range, so I'm not going to draw a target for it yet, although the CCI has broken above the moving averages. And we may see further upside in the coming days. Now, if we go to the hourly chart, we always look at the micro levels, and we've got the daily here as a reference. So bullish move on the CCI, but still bearish on the price. So we don't. If you're trading on the hourly, we want to go in a direction when both the CCI and the price are also bullish. But at the moment, avoid trading. You'll notice here as well, we have a bit of a break to the upside on both the price and the CCI on the 1 hour chart. But notice it's broken below again. So looks like there's more momentum on the short side at the moment, even though we've got a bullish divergence on the hourly as well. I've drawn a target range here in that Fibonacci range. So again, we need to see it break into that if this divergence is to play out. And by that stage, we should see the price also on the daily break higher towards those moving averages. And what we have here for KOLD on the daily chart here, we've got the weekly here as a reference. So we only go short in the direction of the weekly. And that aligns with these points here on the daily chart. So you would have taken your first trades there. This is the average down approach. You'll notice here we had single entries only up until this point, and you would have closed it out here. Why would you close it out there? It averaged down and eventually closed out with a profit, but why would we average down, and why would we stop it there prematurely? Now notice up here the the stop loss approach, these look like they're averaging down, but they're not. It just means they're entering more shares or more contracts compared to these periods back here. But why would we stop this prematurely on both the stop loss and the average down approach? Because notice down here, we've got a bullish divergence versus lower lows on the price. And that trough there on the CCI, in alignment with that trough on the price, higher lows on the CCI versus lower lows on the price, that would have been your first indication that the price may start to rebound and go higher. Now, in this case, it dropped in your favor if you're going short, but you don't want to chance it. So while you're in front, you would have stopped it prematurely there. So if you got out of it there on both the stop loss approach and the average down approach, the average down approach generated $432 and the stop loss approach generated $180. So for UNG on the monthly, it's broken a fresh breakout above the moving average of the price, and also it's been bullish now for a couple of months now for the CCI, even though it's a very narrow range. So bullish move on the monthly. On the weekly, we did have this bullish divergence with the CCI still rising, and that's actually eventually broken through that moving average range, giving us a nice strong bullish momentum on the weekly chart. On the daily, if I zoom in on this one, similar to the other charts, it's hit this resistance at 24.13 and it's starting to pull back. Although it's had a green candle in the last day of trade, last week or this week, the CCI is still dropping potentially with this bearish divergence. Lower highs on the CCI versus higher highs on the price. Now, if I was to draw a target range for that, we take it from that high down to that low. Now, you could argue that's already possibly hit the target. Let's draw our little target range. So going from that point to there, you could argue it's already hit it. And if that bounced higher from there, then you could argue it's already hit its target range. So again, that's at 22.18, and the lower of that candle was 22.14. So yes, it's already hit it. But notice again, the CCI is dropping still on a daily, so we might see further downside possibly. Now, if you go to the 1 hour chart, this is the daily again as a reference. There's that divergence. We see if there's any other divergence in play. Now, we had a bearish divergence here from that high to that high on the CCI versus the same period on the price. That's a bearish divergence. And if we draw a Fibonacci between that high and that low, again, very similar to the daily. In this case, they align. You can see there it's already hit that range on the 1 hour time frame. And for UNG, the last entry would have made, this is the daily chart, this is the weekly. The last entry you would have made on the daily trade, you would have gone long at that candle there on the 16th of December, which coincided with this period back here on the daily. So again, the CCI is broken above the moving average range, as so is the price, and you would have entered your first trades there. This is a stop loss trading, again, all single entries, and you generated $332. And in this case, the average down approach didn't average down any. It entered only single trades, single entries, and that generated $511. So still more than the stop loss approach, but the price didn't dip back far enough to average down. So again, this one was still profitable, even though we did an average down on the daily chart for UNG. So again, using the CCI 150 as our trading strategy for the CCI 150 trend above its moving averages, but also the moving averages on the price chart. If you're trading on shares, we trade with $1,000 lots. So of course, you can put in more, but you need to have deeper pockets, obviously. But I'm using and demonstrating $1,000 of per trade, and you take profit of 3%, and you average down of 5%. We average down no more than $10,000. And for the backtesting for the CFD contracts, we use the time frame of 1 hour. So invest one contract per trade, average down limit of 15 contracts, take profit of 0.003% and average down of 0.005% whenever you're taking those trades.
To support the channel, hit that like and subscribe button, and for added benefits and for a cost of a coffee each month, consider subscribing to the Patreon page where we look at weekly scans of bullish shares across various regions. Thanks for watching, and see you in next week's video.